Welcome, everyone. Today's explainer is an absolute deep dive into a company that is standing right at the intersection of groundbreaking scientific achievement and, quite frankly, harsh economic reality. We're looking at Iovance Biotherapeutics, ticker symbol IOVA. Now, on one hand, this company is pioneering a truly transformational approach to curing cancer. But on the other hand, they're navigating the incredibly cash-intensive realities of commercializing biotechnology. It's a classic story of medical breakthroughs battling market realities, and honestly, it makes for a brilliant case study. Okay, let's dive into this incredibly compelling paradox. In the first quarter of 2026, Iovance posted a massive 45% year-over-year revenue growth. I mean, for most companies, a 45% jump in sales is cause for pure celebration, right? Yet, Wall Street remains deeply divided on the company's future. You've got these passionate, almost polarized narratives on both the bull and the bear sides. So how is that even possible? Well, to understand the numbers, we first have to understand exactly what Iovance is selling, because it is definitely not your traditional pill in a bottle. Section 1. The TIL therapy breakthrough. Before we even think about unpacking the balance sheet, we have to grasp the science here. TIL stands for tumor-infiltrating lymphocytes. These are naturally occurring immune cells that are constantly patrolling your body, looking to recognize and attack cancer. But when cancer actually prevails, these cells just get exhausted and overwhelmed. So Iovance's therapy involves taking a portion of the patient's own tumor, extracting those exhausted TIL cells, and then manufacturing literally billions of them outside the body. It is a highly individualized, one-time treatment that takes those reinvigorated cells and deploys them right back into the patient to destroy the cancer. This isn't just a treatment, it is harnessing the patient's own immune system in a highly personalized way. And importantly, they've scaled this process so the turnaround time is 32 days or less, which, if you follow biotech, you know is incredibly fast for customized cellular therapy. So the absolutely crucial point is, does it actually work? Well, the clinical data is exactly why medical professionals are so excited right now. Iovance isn't just going after the easy targets. They are targeting difficult solid tumors where patients have literally exhausted all other options. We're seeing a 40% confirmed objective response rate in metastatic serous endometrial cancer, a disease that accounts for roughly 40% of U.S. endometrial cancer deaths. In advanced non-small cell lung cancer, which is a massively prevalent disease, they're seeing a 25.6% response rate with unprecedented durability. And in early data for advanced sarcomas, they're hitting a 50% response rate. Remember, these are patients who have often completely failed standard chemotherapy and checkpoint inhibitors. So from a medical perspective, this is a genuine breakthrough. Section 2, Q1 2026 Financial Snapshot. All right, let's transition from those undeniable medical successes to the cold, hard financial realities. It takes a ton of money to manufacture billions of personalized cells, which brings us to their top-line revenue for the first quarter of 2026, $71.4 million. This is that impressive 45% year-over-year growth we mentioned earlier. The vast majority of this, about $60 million, was driven directly by U.S. demand for Amtagvi, which is their flagship FDA-approved T-cell therapy. The demand is seriously accelerating, largely catalyzed by real-world data and a fast-expanding network of authorized treatment centers across the U.S. and Canada. The top-line scale is undoubtedly visibly increasing. Now, what's really interesting about this slide is the harsh reality of the expense column. Bringing in that $71.4 million cost them heavily. Research and development expenses alone sat at over $62 million. When you factor in the cost of sales plus selling, general and administrative expenses, the total costs for the quarter hit over $152 million. So what does that mean? It means that despite the really impressive revenue jump, Iovance still posted a net loss of $79 million for just that one quarter. Building centralized cell therapy manufacturing centers and pushing multiple clinical trials globally is just incredibly expensive. Section 3. Expanding the clinical pipeline. So you might be wondering, how on earth does a company outgrow these kinds of structural losses? The answer is scale. Iovance absolutely knows they can't just rely on their current markets to reach profitability. They are pushing hard into global expansion and broader cancer indications. In the first half of 2026, they're anticipating regulatory decisions in Australia, followed by Switzerland in early 2027. They're also actively working with regulators right now in the UK and the EU. But honestly, perhaps the biggest catalyst on this entire timeline is the target for the second half of 2027, the potential U.S. accelerated approval and launch for non-small cell lung cancer. Lung cancer is the leading cause of cancer death worldwide, so breaking into this massive market would fundamentally change Iovance's revenue ceiling. Section 4, the bull versus bear debate. This complex mix of high revenue growth and heavy net losses has basically created two very distinct camps in the market. Looking at the trailing 12 months provides the perfect battleground for these two viewpoints. On one side, the bulls look at the top line. Trailing 12-month revenue hit $285.6 million. They see a step down in trailing losses compared to the prior year, and they argue, hey, this proves Iovance is successfully scaling up, meaning future margins will naturally improve as that revenue continues to climb. The bears, however, are looking strictly at the bottom line. They point out that even with revenue approaching $300 million, the company still posted a massive $353.9 million trailing 12-month loss. To the bears, a clear, definitive path to actual profitability just isn't visible yet. And this brilliantly illustrates the tension between future promise and immediate risk. The bulls are betting heavily on restructuring. Iovance currently has a 41% gross margin, but they've recently centralized manufacturing at the Iovance Cell Therapy Center, and they're rolling out operational efficiencies that the bulls believe will dramatically reduce costs in 2026 and 2027. The bears acknowledge that potential, sure, but they are incredibly focused on the runway. Iovance is forecasted to remain unprofitable over the next 3 years. Even with $319 million in cash on hand as of March 2026, bears warn that sustained unprofitability often requires raising more capital, and we all know what that means, issuing more stock, which ultimately dilutes the value for existing shareholders.
Section 6. Wall Street's Verdict.
So, with such a polarized debate between operational risks and clinical rewards, where do the financial experts actually land? Well, despite the heavy ongoing losses and some very legitimate concerns from the bear camp, Wall Street analysts remain surprisingly optimistic. Out of the 6 analysts covering the stock, literally none of them recommend selling. 17% say hold, 50% say buy, and 33% rate it a strong buy. This aggregate rating tells us that for the majority of these analysts, the underlying medical data, those incredibly impressive response rates in desperate cancer populations we talked about, provides a strong enough foundation to justify the financial execution risks. They clearly believe the science will eventually dictate the economics. And that optimism is heavily reflected in their price targets. With the current price hovering around $4.54, the consensus Wall Street target sits way up at $9.50. That represents a massive 109.3% potential upside. This number just perfectly encapsulates the high-risk, high-reward nature of investing in commercial-stage biotech. The market is currently heavily discounting the stock because of the execution risks and the cash burn, but analysts believe that if Iovance successfully navigates its pipeline milestones and improves those manufacturing margins, the ceiling is incredibly high. Which leaves us with the ultimate question of this explainer. Does Iovance's long-term medical promise outweigh its short-term unprofitability? There is absolutely no denying that TIL therapy is changing the landscape for patients with advanced solid tumors, offering genuine hope where traditional treatments have failed. Yet the financial gravity of revolutionizing cellular manufacturing cannot just be ignored. Whether you align with the bulls who see an impending margin turnaround or the bears who fear prolonged dilution, Iovance Biotherapeutics remains one of the absolute most compelling stories to watch in modern medicine right now. Thank you so much for joining me for this explainer, and I'll see you next time as we continue to break down the complexities behind the headlines.